Okay, beautiful. Thanks again. All right, everyone. Well, hello, welcome again. I won't give you a second big welcome. I think Jackson did a great job at that. But I will say thank you for being here. Really honored that you're here and that you're willing to invest an hour of your precious time with us, with me. Sometimes I'm surprised you're willing to do that, but I'm always grateful that you are. I'm just kidding. I'm not that surprised because we've got great charts to share with you, a good market update to share with you. Even if the news isn't always terrific, I can tell you one thing, it's always accurate here. It's always factual. And we're going to kind of talk about what's going on. So here we are. I thought this was kind of a cool one to start us off on. There's a lot of uncertainty. Well, I should say there's not a lot of certainty about much of anything in our world anymore. But I can say with confidence that right now is a very, very interesting time to be looking at some market stats and some of this market data. So I'll just say that. I will also say we've got a whole bunch of tools, tips, tricks, and resources for you guys to help you succeed, to help you understand the market, to help you navigate this market, to help you get more deals, grow your business, be more strategic. And there's a whole host of other benefits that you guys get, when you use this, when you use these tools and resources. So I really do want to state that pretty clearly. Let me also say, we've got a bunch, right? We've got a whole bunch of tools and resources for you guys. These are just some of the reports. I won't go through all of them, but I will say we've got a weekly report. We've got the weekly pulse. Jackson mentioned that one. We've got our monthly indicators. We've got our local updates. We've got a housing supply report, foreclosure and short sale report, our annual report coming out in just about 2 months, I think. So that'll be exciting, always is. We've got our skinny video. We used to do more quick takes. We've kind of sunset it, but if there's anything interesting or major, we may hop on and do a quick minute or 2 minute video. Although personally, I prefer spending an hour with you guys to dive a little bit deeper and having the time to really dig in. Webinars, you are here. You are here now on the map. You are here at the webinar. Sortable stats. I don't think everybody knows about that one. If we have a minute, maybe I'll jump in. And then InfoSparks. I call it the Holy Grail. It really is. It's your one-stop shop to customize whatever kind of market analytics you're looking for. With that, let's just dive into our monthly indicators. I like to showcase this just to kind of show you guys how it looks. I hope it's familiar to most of you, but I understand that it may not be. So let me just blow through it real quickly. You guys can see all of our key metrics. So new listings, pendings, closings, sales price, inventory, you name it. We've got October of last year compared to October of this year. And then intuitively, your plus minus here is going to be your change, year over year change. And then we've got year to date as well. And these figures are the year to date change. So for the first 10 months of last year compared to the first 10 months of this year. Dive a little bit deeper into the pages that follow. This is sort of like a table of contents. Then you dive into the new listings, pendings, closings, and so on. You've got last 3 Octobers, the last 3 year-to-date periods, and then you've got the actual raw data for the last year. So know that that is a tool that is absolutely available to you guys. Let me just hop into our local market update. I thought we had maybe some newer folks on, so I just want to spend 30 seconds covering this. You guys will notice this was for the whole Twin Cities. It has really big numbers because it's for the whole metro. This, you might guess, this is just for Shakopee, not for the whole metro. And so you'll see less activity. You'll see more volatility because it's for a smaller area. But, I'll also say this is much more meaningful, I'll say, for sellers and buyers because people don't buy into the entire metro. I mean, I guess they kind of do, but they mostly buy into a city, even a neighborhood. It's not even really good enough to say, oh, I just bought a house in Minneapolis. Northeast, South, Longfellow, North, downtown, even downtown, Elliott Park, North Loop, Loring Park, downtown East. What are we talking here? Because even downtown, those neighborhoods have different vibes, right? Very much different vibes with different amenities and whatnot. So just one way to sort of break out activity by area, some geographic breakouts here. I always like to cover briefly the so what. So why should I care about this? I've gone through some, believe it or not, I've gone through some presentation training, over the years. And one of the questions that they ask us to focus on is the WIFL question. WIFL, what's in it for the listener, right? So what's in it for you guys? I'm not just here to talk about stats, although I am here to talk about stats because I like stats and I think it's a fascinating time and a fascinating market to be looking at them. But let me say this. How will this help you? You guys get asked these questions by your buyers and sellers. Is this a buyer's market or a seller's market? If you've got 2 months supply, it's sellers. If you got 7 or 8 months of supply, you're leaning toward buyers. How do townhomes and condos compare to single family? Is the median sales price rising, falling, or flat? How long will it take me to sell my home? Well, 17 days on market if you're under 300,000, maybe more like 19 or 21 days on market if you're between, say 500 and 750, something like that. Here's a popular one if you're a seller. I know we're asking 400,000 for my house, but am I going to really receive 400, or might I get 390? Or a year and a half or 2 years ago, you'd get 425 or 430 on your $400,000 asking price. Inventory, new construction, what's going on with townhomes and condos, what's happening with foreclosures and short sales. Guys, we encourage you to be the expert in the market. It is not out of reach. It is absolutely within your capability to refine your skills, hone your skills, and become even more of a market expert. So we very much encourage that. Okay, let's take a little walk down historical memory lane, if you guys will allow me, if you'll join me. Sometimes we do this. It's not good enough to say this is what happened from last year. I'm really a big fan of looking historically and saying, where are we compared to past cycles? So both where are we within this cycle and how does this cycle compare to past cycles? You can kind of compare to the last time inflation levels were this high. You can compare to the last few recessions in 2001 and then 07, 08. And so it really just helps to sort of contextualize the present, in the past. I guess I'll put it that way. So a couple things to note. All the way back to 1967, blue is seller activity or new listings. Red is buyer activity or closed sales, right? We've noted that right up here in our handy dandy legend. So check this out, everybody. Look at when seller activity is on the rise, but demand is rising, but not as much. That gets us into trouble. Look again here. Look at when seller activity or supply is on the rise and demand is actually falling notably, right? And that was during the GFC, Great Financial Crisis, also the mortgage meltdown, however you want to refer to that period. So what happens when you see supply levels growing and demand flat or shrinking? Well, you're right. Prices usually soften. Prices usually adjust downward when we have that combination of activity. What are we seeing happening now? Do we see that divergence between supply and demand? I don't at all. I see both down, right? I see both seller activity and buyer activity sort of trending downwards, not diverging, I suppose, not converging, but they're both sort of moving in tandem. I hope my little hand, my acting like a mime, I was both a meme and a mime. So I hope that wasn't too confusing. So just so you guys kind of understand how this differs from last cycles, how this sort of activity is actually not consistent with a bubble. These are bubbles. Bubbles are almost always supply-driven bubble. We don't have a supply-driven bubble. We have a shortage, right? And that's what's causing prices to rise. So just a little bit of history there. A little bit more history, this time back to 1960. I'm going to speed through this one because I got a good amount of content to cover with you guys today. So blue is just average sales price, guys. Don't overthink it. I've put a sort of a lower and upper bound on it because that's sort of that long-term average. If prices rose at 5% steady eddy every year, we would be dead in the middle of this channel, but we're not. That's not how markets move, right? So we're kind of above the trend and then kind of got back to trend. Look at our housing bubble, 04, 05. We were way above trend, and then we had our crash into 2010, 11, 12, and we were below trend. And then we've been recovering ever since. Looks like we're just back in that trend, but now we're cooling off. Prices have not fallen this year, but the rate of growth sure has slowed. And that's what we're seeing happening here. So just as we began to sort of kiss that trend line, it looks like we could be sort of flattening out a little bit, which if you ask any buyer, that's a good thing, and probably healthy no matter, well, most sellers still want their home to, rise in value by 12 to 15% every year. Unfortunately, that's not the way it works. So it's a healthy and sustainable thing for growth to cool off a little bit. I wanted to highlight sort of some different periods or eras or cycles or, well, really decades, if you will. So here we have some stagflation and then kind of later inflation in the 1970s. Late 70s, early 80s, remember hyperinflation. So we had a little bit of growth, but then we had that hyperinflation period. And look at that. Interestingly, prices actually were still growing, but more slowly. The rate of growth slowed. 1990s ushered in really fast growth, historically strong growth in the 90s. That, of course, was followed by some deregulation, and that allowed us to sort of inflate our housing bubble. So that is what you see here. Then you have your 08, 09 crash, 2010s recovery, inventory shortage is kind of the hallmark of that era. And then 2020s, here's the COVID boom, right? 21, 22, and then into 23, that's the slowdown here from the Federal Reserve with their rate hikes with higher interest rates. I like to show this one just about every time, so some of you might be sick of it. This is from 1982, rates starting at, you got that right, 18%, folks, with a point, but you can buy down to 16 3/4 with 5.5 points. If any of you know Pat Paulson with Exit Realty, great guy, pretty active and engaged, and we're really grateful. He gives us a lot of feedback on what he's kind of seeing in the market. Your number if you want to try his pager. So, 42 years ago, and he's still kind of on people's minds. Kind of interesting. If you feel like trying the pager. All right, a little bit of trivia night, guys. I want you to throw in chat what you think the average mortgage rate is since 1970. That's what I'm going to ask you to do. Throw in chat what you believe is the average mortgage rate between since 1970 and yesterday. See what we got: 7.5, got a 9er, 11, got an 8, got a 10er, 8.5, another 10, 6. Lance coming in at 10. I gotta give it to a couple more coming in. Tim at 8.25. Any others? All right, we'll call it there. Our friend Seth from the State Association wins the day at 7.5. It is actually 7.74. So I think there was an 8. So if it was 7.76, then Michelle would have won, right? But since it's 7.74, Seth is the winner. Seth, I'll drop off a pack of Lifesavers or something. I'll drop off some extra Halloween candy, maybe in the new year. Anyway, so yeah, you guys, that's right. Seth got it. So just about 7 3/4. Well, what's the current rate at? About 7.5, right? It was just 8. Now it's down to 7.5-ish. So that is just about average. We're just about at average. It doesn't feel like it, but the fact is we're just about at average. If you ask millennials, is this average? No, it's terrible, they think, because they've been conditioned by ultra low rates around 3 or 4%. So suddenly 7 or 8 feels like the sky is falling. Everything's relative, right? Everything's relative. All right, diving deeper, let's go through some of our major metrics. These guys are hopefully familiar to you. New listings, they were pretty high. Then they came down. A little bit of recovery, sort of ebbing and flowing a little bit. We saw that listing activity in 2020 when folks were putting their homes on the market and looking to move to get more room, another home office, another home classroom, maybe some space for your coronials. That's the generation of children born after 2020. Coronials, that's a technical term. I wish I made it up. I did not. Extra bedrooms for their coronials that millennials are having, another work from home or a learn from home space, stuff like that. So you saw all this moving, and then you saw 48.95 is the lowest figure for October new listings in 21 years, right? So that is a 21-year low for October. I wish I had different or better news to report, but I don't, and I'm not here to make you feel good. I'm here to tell you the truth. So that's what the North Star data is showing us. And guys, don't wonder why. We know exactly why. Outstanding mortgages, most of them have rates below 5%. Well, blue is sub 3. So this is 1, 2. No one really has 1. This is, some people do have 2.5 or 2 3/4. So this is a sub 3%. In green, this is 3 to 4%. So what I do, guys, just combine this light blue and this green together, and that's basically anything under 4%. So help me out. What's 45 and 25? Just about 70%. Did I do that math right? So just about 2/3, you guys, just about 2/3 of outstanding loans are financed at sub 4% rates. You've got me by the golden handcuffs, right? We're wearing the golden handcuffs. I am married to my interest rate. Lucky for some in this country, we've got a 56% divorce rate. So even if you're married to your interest rate, you know, I guess technically more than 50% odds that you might break up with the rate anyway. Some call this the lock-in effect, right? The lock-in effect or the golden handcuffs. I am so committed to sticking with my, whatever, 3-4% rate, even 5%, that you can't pry it from my cold dead fingers if you wanted to. Anyway, you guys get that. Okay, October pendings. Wow, you can see a pie in the sky here with contracts signed as we got into fourth quarter 2020. Wow, 25% increase in the number of signed contracts. Every action has an equal and opposite reaction, doesn't it? With that surge in activity, we've had to pay some of that back, right? The Fed sort of made us pay some of that back. And I suppose low inventory has also made us cough up some of those gains, so to speak. A little bit less dire than new listings at about 3,500, right? We're technically above some of the lowest of the low, but not by much. All right, let's do a little game. Well, not a game. Let's do another little experiment together here. This will be an interesting one. Are you guys with me? Can you kind of see that this is sort of the trend for October? Look at how we passed through almost the middle of every one of these, right? So I'm kind of starting here. Remember 2009 was a tax credit period. So that was a little wonky. And then we kind of had the payback for that, right? There's always payback. After you have a night out, you always feel a little crummy the next day. So look at this. This is sort of this long-term trend. Yes, these were a little above, these were a little below, but this is our long-term trend. Watch what I'm going to do here. There's the path up, there's the path down. There's the path down, there's the path up. So we are not here yet. We are here, right? You are here. I guess what I'm saying is over time, everything gets back to trend. It's just a matter of kind of how long it takes. Does that make sense? I think it's kind of a cool way, I suppose I could have done a little better on the visual, but it's kind of a cool way to see when we go above trend, we're usually then below trend. And again, it's just kind of a matter of time until we do get back on track. So keep that in mind. Year-over-year change in sales. Speaking of getting back on track, and for this one, I want to use my little my handy dandy magnifier here. So look, a pretty big decline. What was that? That was our percent decline, 32% over year. Well, what do you guys notice since? I noticed that for the most part, right? And that's a good thing. We are as I say, it looks like we're not going deeper into the woods, and that's a good thing. Something really nice, depending on rates and depending on recession. I'm not sure what that was about. Did I lose you guys? I think I lost you guys for a second there. Okay. Well, let's get back. I hope not all is lost here. Okay, so I was saying, yeah, so just watch for these changes. Watch for these changes to continue to moderate, and let's see what happens next year. All right, next. Okay, so yeah, pending. We've kind of done pendings, closings. I don't mean to go through all that, but just know they're very similar. Although not everything that goes under contract obviously closes, so keep that in mind. CDOM, cumulative days on market. We were up last October. Believe it or not, we're down this October, or down last month, I should say. So from 2 weeks up to about a little over 3 weeks now, just a hair under 3 weeks. I think a lot of buyers out there would be surprised at that. I think a lot of buyers would be surprised that homes are selling more quickly than they did last year. That's what I think. Median sales price, October, we did just about a 2.5% gain. You guys will notice, let me get my magnifier again. You guys will notice that 2.5 is pretty slow compared to the last, 10 plus years. In fact, that is the slowest in the last 10-ish years. And so no, prices are not falling, but they sure are rising at a slower rate, right? Price growth is still positive, but it has decelerated. Our car is still going forward on 35W, but instead of going forward at 70, we're now going forward at 40, 45 miles an hour, and we're getting the horn from people passing. October ratio sold price to list price. Really like this one. Sometimes I worry if I say that about all of these metrics, but I really like this one because it speaks to negotiations. What are sellers accepting? And it speaks to, are we leaning towards sellers where they're getting 100% or better of their list price? Or are we leaning toward buyers where buyers are able to negotiate 91, 93, 94% of list price versus 100.5, 100.33, or 98.5, which is still pretty strong, as you guys can see, historically speaking. These were exceptional times. I hope that's pretty clear to everybody. Inventory down another 7.5% to about 8,600. I guess that's slightly above October of 2021, but not much. Some of you remember we used to have 35,000 listings on North Star MLS. We now have just over 8,500. Month supply of inventory with 2.3 months supply of inventory. What does that mean? It means we're still in a seller's market, but it also means that it's not as strong of a seller's market. Sellers don't have quite the power, the negotiating power, the pricing power. Market times, I guess, down slightly from last year, but definitely up from 2020 and 21. So they're not in quite as strong of a position, but it is still a seller's market technically. And again, I think a lot of buyers, are missing that, and they're just assuming that all of a sudden we must have 6, 7, 8, 9, 10 months of supply, just because interest rates doubled. That change has definitely rippled through this metric. I think there's no doubt about it, but 2 1/3, 2.5 months of supply is still a decent seller's market. It's not a 1.5 or 1.2 months of supply, like I think we saw for a few months, not October months. I think that was a May or a June or July back then, but it is still a seller's market. Well, let's think about this for just a second, guys. And in the interest of time, we're going to kind of blow through this. A seller's market, there's only one seller, but there's a lot of buyers. Sellers got all the power here. They can name their price. If this gal is lowballing, see ya. If this guy wants me to give a warranty and wants me to pay $5,000 in closing costs, see ya. Oh, this guy's offering full price. Okay, I'll hang on to that. Well, this guy's offering 5% over list price. That's what happens in sellers markets. Buyers markets, a little bit different. We've got a decent amount of inventory relative to, falling demand. So here it's the buyers that have to compete with each other in multiple offer situations. Here it's the sellers that have to out concede one another, where they have to offer, seller paids, price reductions, other concessions, home warranties, repairs, right? Even repairs, water heaters, that kind of thing. All we're looking for, gosh darn it, is a fairly balanced market where we've got supply and demand sort of well synced up with one another. All right, keep trucking. So I want to throw in just 1 or 2 year-to-date figures, just looking at price. We did have a price decline this year. I'm 98% sure it was May. And then we had some flat months where we had some 0%ers. But then we've had some 2.5s and 2.7s. 1.4 or 1.5 is just about in the middle of that range. I want to mention, again, not a lot of guarantees in this world, but I'm ready to make you a guarantee. I'm ready to bet big on this. Median price will be up between 1% to 2% this year. I am willing to bet big. Anyone want to take that bet? Come find me after class. So much of the year's already in the books, right, guys? We've got 10/12 or 5/6, right, which is a really good chunk of the data already in the books. November and December sales, first of all, they're winter months or colder months, so they're almost always slower, or actually always slower. So there's just not enough data. Even if it was above the average or median or below, it just wouldn't be enough to really move the needle. Well, it looks like you're asking $450,000 for your house. Best I can do is $80K. It's the best I can do. Although I'm not really sure, so I better call in an expert. Anyway, you got to have some jokes when you do housing data, guys. So thanks for humoring me on that. Year-over-year change in median sales price. I could spend 20 minutes on this alone. I'll spare you that, but I will say, look at prices rising in the bubble, 04, 05, into the crash. Look at this. Look at these declines in 09. Little bit of stabilization around that tax credit period. So year-over-year price growth was actually positive and relatively strong. And then look at this. A lot of flippers and investors here scooping up foreclosures with cash. This is more of a normal growth rate. And then look at COVID. Look at this surge in price growth. Look at the acceleration in price growth, I should say, during COVID. And then as the Fed really started to pour cold water on the market, you guys can see there's our 1 month of price declines. There's our one lonely month. And then we are positive, but definitely slower growth than what we've seen. Supply demand ratio. Let's kind of blow through this one. I guess it's interesting, but not that exciting. It doesn't tell us anything that different than month supply. So 2 homes per buyer, right? That is the highest supply demand ratio since 2015. And during the COVID frenzy, right? And this is just October. Look, we had 0.8 of a home per buyer. We had less than 1 home per buyer. So at least now we've got more than 1. We've got about 2 homes per buyer. The issue is, are either of them affordable at a monthly payment that your median earner can afford? That's the struggle. Ooh, price reductions. I've got August and I think I've got October too. Here we go. This is fun, guys. Check this out. August price reductions, October, August, October, August, October, August, October. All right, enough of that. So let's take a quick peek. Price reductions. Yes, they were down during the COVID buying frenzy because I didn't have to do a price reduction. I had 50 offers. Half of them were at or above sales price. I had no need to do a price reduction. Up from these levels, but actually still below the pre-COVID levels, still below 2018, 19, and 2020 levels. And a far cry from the 50% of listings that required one form or another of price reduction. So this one's pretty interesting. I really like the way this is put. So a lack of affordability and higher rates are really preventing prices from rising much, but a shortage of supply and the inventory constraints are really preventing prices from falling too much. So you kind of put a band around it, right? It's like a cushion. It's a floor and a ceiling, right? Supply is kind of holding up the floor, but then rates are kind of pushing down the ceiling a little bit. So another interesting thought, pent-up sellers will eventually create the supply that should be met with demand from the pent-up buyers, right? So we've got 1.5 years, almost 2 years of pent-up supply and demand. So I guess that's one way of saying don't expect a huge glut of listings in spring, because as they're listed, I think you're going to have some of that demand coming out of the woodwork, especially if rates do touch, 5.5, 6.5%. I know that would really be a game changer. Speaking of game changers, guys, we saw rates go from 8 to 7.3, maybe 7.4-ish, and that was national. So that's not all local, that's national. Well, guess what? What's 8 minus 0.8 would be 7.2. So that's a what? An 8%. That's almost a 10% decline in rates. So, reach out to your buyers and say, depending on your price point, that could be a $200 a month, 100, 200, even $300 a month difference on the payment side. So that's worth looking into. Speaking of rising interest rates and people not wanting to make higher monthly payments, folks are leveraging cash, right? Cash deals at 17.2% of closed sales. So just about 17 out of every 100 sales are conducted or transacted in cash. You guys will notice, oh, it looks like we did eclipse 2014. That is the highest level since 2013. Pretty interesting kind of high water mark there, at least a nearly 10-year, about a 10-year high for cash sales. No surprise, right? Instead of paying 8% or 7.5%, I'm going to leverage my cash if I've got it. Assuming you've got 360 grand burning a hole in your pocket, a lot of millennials don't have that, especially first-time buyers. Now, move-up buyers who might have 200K in equity from the first home, maybe they can find that extra 100 or 150 from savings, from 401k borrowing, from the bank of mom and dad. I'm sure some of you have found yourselves in that banker position. Some of those second and third time move-up buyers are going to have an easier time doing that. You know who's going to have the easiest time is boomers, right? Okay, boomers. Those guys who are downsizing from a 5-bed, 3-bath home to a 2-bed, 1-bath townhome, or maybe 2-bed, 2-bath townhome, single level living. They're going to bring cash from the first one. And those guys will have shouldn't have too much difficulty in leveraging cash. Everybody's situation is different. Everybody's income and assets are different. But if you have that much time to accumulate housing wealth, I think the odds are pretty good that you can deploy your cash. NAR, this is from 2 days ago, at the NAR next convention, well, both committee, convention, conference, it's all of it, in Anaheim, taking place as we speak right here. So nationally, it's more like 30% versus a high of 35. And what were we? 17 versus a high of 23. So we are lower, of course. And nationally, guys, you're influenced by New York, San Francisco, California, Washington, Florida, a lot of cash in Florida, as well as Texas and elsewhere. How about million plus? Wow. Over 1 in 3 million plus deals are done in cash. Over 1 in 3. Wow. And that's up from about 1.25, which was pretty flat for 4 or 5 years. Pretty interesting there. If you've got the cash to buy a million plus home and you don't want to pay interest rates, I probably would consider doing the same. All right, guys, let's talk about some market share. We're going to talk some market share charts here. I think you guys have seen most of them. We've updated them. So every few months we update them. These are annualized. So we like to give it a few months to kind of move the needle on the data. And then we refresh the North Star data. And actually things have changed a little bit, not a ton, but a little bit. Let's look at the percentage of all sales that have 4 or more bedrooms. Look at the COVID impact. Look at that COVID signature. So clear, 42%. Home office, home classroom, second home office, second home classroom, so on and so forth. We have seen this trickle off just a little bit. 39.8 is the lowest figure in 5 years, right? So that's pretty interesting. What does that reflect? The need for buyers to get their payments under 2,500, under 3,000, under wherever they're comfortable at. That is one way. They're entertaining 3-bed homes instead of 4 or 5. One way that they're sort of adapting to deal with this new normal, if you will. Square footage. How come we had such small home selling here? Condos, right? Condos. tend to be smaller. What was going on here? COVID, homes tended to be bigger, and a lot of them single family, and a lot of them having that home classroom or home office or stuff like that. We did see a decrease then following, but then we have seen gains, small gains, and we're actually still below that figure, although not by too much. So we are technically below, although we've seen growth. Pretty interesting there. Townhouse condo share, percentage of all sales that are either townhomes or condos, little over 27%, not quite the 28% that we saw again during the sort of townhome condo bubble or boom. But no surprise here either, you guys, that this is the second highest share of townhomes condos in 21 years. No surprise. You want to know why? Well, after this one, I'll show you why. I'll show you exactly why. So single family market share, of course, as condo share was strong, single family share is lower. Then we saw, sort of a shifting back to the single family market. Look at COVID, little single family surge there. And now, since this is actually our second lowest single family market share figure on record since 2003. So this is almost a 21-year low. No surprise. Why is single family market share down? No surprise. I'll tell you exactly. There's why. There you go. Right there you have it. So single family median price, $400K. Condo median price, just over 200. Townhome median price, just over 300. No wonder. It's no wonder folks are leaning a little bit more toward those property types, as this one feels unfortunately out of reach for too many, right? Not everybody, but especially for the 50% of Minnesotans earning below that median income, this is a tougher hurdle to pole vault over. I mixed up my track metaphors. This is a higher hurdle to leap over, or a higher the bar to pole vault. You guys know what I'm saying. New construction market share, 12%. I always give a caveat. I always give a little pre-warning here. If Lennar or D.R. Horton or Pulte and M&I Homes, did they merge? I can't keep it straight. I know Hanson Builders, there's some other smaller builders, Weiss Builders. Forgive me if I don't mention you. If they don't list their listings on Northstar, I can't capture them. So we beg you guys, we beg them to at least enter them as comp sold, so that we can all benefit from the data, and so we can have that transparency. Long story longer, when I say 12%, the truth is probably more like 13 and a half. Here, when we were saying 15%, the truth was probably, again, more like 16 and a half or 17. So we're really confident in the trend, really confident in the trend, but we're only about 96% confident in the level or the figure, because not every new home goes through the MLS. You guys can see growth here. It's nice to see some growth. We need new construction, but you can also see that we are not quite back to those levels. Building permits really never recovered, guys, since 2005. We've had 2 decades of underbuilding. That was for the Metro. That was for the 16 county Twin Cities. Follow me, if you will, down south on 35W to Lakeville. Over 1 in 3 sales are new construction, right? Over 1 in 3. That's about 3 times the market share of the Metro. Threefold, right? 12 to 36 almost. So that's pretty interesting. And you guys can kind of see how that compares kind of during the boom years and the crash. And now let's hop into Blaine as well. Similarly, 1 in 3 Blaine sales are new homes. Quick note. Oh, darn it. I missed a not. That really changes the meaning, guys. Please forgive me. It's not that new home building has surged as much as existing home sales have slumped. It's not that new home sales have surged as much as existing home sales have slumped. That means the same number of new home sales are making up a larger share of a shrinking pie. A little wonky, and please forgive my omission there. I will get that corrected. FHA loan. Some of you are working with FHA buyers. It definitely has some benefits and some drawbacks, just like anything else in life. Not much demand for FHA when conventional lenders were getting very creative. Some exotic loans, some adjustables, so not a lot of FHA. And then all of a sudden, a lot of FHA when the market sort of melted down. There's been a few kind of blips and bumps here, but we do see a little bit of an increase that I think is explainable again by the changes that we're seeing in the market and the rate environment, big time in particular. Conventional loans, lion's share of the market during the 05, 06, 07 era. Private sector wanted to get out of the market. Let the government handle that, right? Let FHA take that risk. And sure enough, over 1 in 3. And so, look at the increase in conventional, but then look at the decrease. So 69.9 is the lowest level since 2018. So that is a 5-year low. Sorry, what did I say? Yes, that is a 1, 2, 3, 4, 5-year low for conventional financing. Interesting one. I bet a lot of you have not seen this one. CFD, contract for deed. Contract for deed, as most of you know, has some ups and downs. But, one major drawback I'll say is that, it's seller financed. So the seller kind of retains the legal title to the property until the payment plan is completed. So on the one hand, right, that means that the seller is responsible for things like property taxes. But on the other hand, the buyer lacks the security and really the rights to their home. So some concerns around that, but it's creative. And if it's a consensual agreement, then, free market, buyer beware. But there are obviously some very well-founded concerns. I do see 0.25%. That is up a little bit from sort of pre-COVID levels, not by much. You can see, way down in 2021. So that's something that we're monitoring. Let's kind of see what happens with that one. Let's do a quick time check. 47. Oh gosh, I'm not moving fast enough. Percentage of adjustable loans. Come way down, you guys. Look at the 09. Look at this Great Recession in gray here. Adjustables almost 1 in 3, right? About 1 in 3. Now 5% less, right? 5 to 7%. So it looks like we've sort of learned our lesson, which is good. Luxury, Deluxe. Closed sales over 1 million, September. I think we saw this, sorry, we might have seen this 2 ago. So you guys can see, look at million plus. On the rise, on the rise, on the rise, and it really has maintained that strength. It's been strong for the last 4 Septembers. Let's go October, September, October, September, October. Not a big difference, guys. It still has retained, that strength that it saw during the COVID era. We saw a good chunk of these are done in cash. So it's sort of, how should we say, rate agnostic, or it's not as sensitive. The luxury segment is not as sensitive to changes in interest rates. If they do finance the homes, they've got that disposable income or enough flexibility in their budget to swallow those interest payments. If they're really fortunate enough, they can pay cash, and they don't care if rates are 220 or 200%. Urban market share. I think this would surprise most folks to learn that the percentage of sales in the metro that are taking place in the 2 beautiful core cities actually hit 17.3%, but that was about 1.5 years ago. You guys can see it's trickled off a little bit since then, but it's actually still pretty close to 7-year highs. You guys can see we're still above this sort of dip. Condo bubble, anybody? Downtown living condo bubble? Let's take a stroll around the big lake, shall we? Lake Minnetonka, median sales price last month. Deep Haven, 1.6 mil. Tonka Beach, 2.2 mil. Tonka Bay, 2.8. Wayzata, 1.4. Woodland, 1.5. With a couple 900s mixed in, some 600, 700s mixed in. You guys can see these are pretty high-flying communities, pretty luxury-oriented communities around the big lake there. Let's take a lovely stroll around beautiful Minneapolis. Price is different. 200, 300, 190, 375, 330, 280, 250, 470, right? 300 around the university. So Southwest is sort of, at close to 500,000, is, definitely hosts a disproportionate share of luxury properties. You'll see Linden Hills, Lyndhurst, Kingfield, and a lot of these sort of higher flying areas that you'll see there. So guys, long story longer, again, areas are different. Different parts of the metro are different. Even different neighborhoods within a city are different, right? We talked about that. It really makes it challenging for us. I'll just be totally forthcoming. It can really sometimes make it challenging for us to talk about the market as though it's monolithic. David, Star Tribune here. Were prices up or down in October? Well, they were up almost 2.5%, but they were down in downtown, but up notably in Phillips, right? So Jackson and I sometimes struggle to talk about this Twin Cities market as though it's the singular thing, right? Anyway, a little bit of an insight into our brains. Distance between home purchase and previous residence. We used to move about 15 miles away. Then suddenly we were moving 50 miles away. Building permits. You guys are used to seeing Woodbury, Lakeville, Blaine, Rosemount, Cottage Grove. I'm starting to see St. Michael, Rogers, Corcoran, and some similar areas sort of creep into the data, which is consistent with folks moving a little bit further out. One of my favorites, how deep is the mud? As always, it depends on who you ask. Case-Shiller data, not our favorite data source, but this is what is used in this visual, so we'll use it. Every major metro, or most major metros, plotted here. January of 2017 all the way through, I think it goes through September. It's not quite through October yet. So you guys can see there's the US in the middle, some performing better, some performing worse. You can see the COVID bump where some markets were experiencing 35% price gains. 35% price gains. And then you've seen some that are actually showing negative price growth. Let's look at some of our fellow winter cities, shall we? New York, Chicago, DC. DC's kind of coldish sometimes, but not quite like we have. Boston, Detroit, Minneapolis, Cleveland. Look at these, you guys. After this, after the COVID frenzy, I suppose DC just barely touched below zero based on the Case-Shiller numbers. All these other markets actually didn't even touch zero or bounced off zero. I think that's pretty interesting. Now let's contrast that with LA, Dallas, Phoenix, the Bay Area, Tampa, and Vegas. Warmer markets, right? Ooh, interesting. All these guys went below zero. Some are up above zero. Most are still below. But that's pretty interesting to me that some just touched and now are back, and others plunged below, some well below, and some of which are not even back. So there does seem to be a little bit of a, what do we say, a climatological factor. Climatological is part of the methodological factor. Anyway, sometimes we joke with words. From our friends at Zonda, I kind of have a crush on those folks. They're real sharp, good data, really do good work over there. Market rankings, this is from September, so a little older. They've got us pegged at a significantly overperforming market. You guys can see some of the underperformers around the Denver area, some of the Pacific Northwest and the mountain states. Of course, Phoenix, that saw just unsustainable growth. Same with Austin. And then our friends in California, good luck out there, guys. And then you see a little bit of the Northeast, sort of average performers, but a lot of outperformers in the Midwest and some in the sort of Southern Atlantic, and then most of Florida, somehow, to the surprise of most, outperforming. Real home prices versus incomes, guys, don't overthink it. This is the US, this is Canada. Home prices in black, incomes in green. Look at Canadian home prices versus incomes. So if we think we've got a problem here, and in a lot of ways we do have plenty of challenges, our Maple Leaf neighbors to the north, our friends to the north, are in a very different world. How's the water? Cold. Really cold. We just had the highest interest rate hiking cycle, as far as I've read or can tell, on record. Other time in recent history. So we can't, well, the Federal Reserve didn't really exist in the 1700s. So we can't go back all that far, but in over, I think this looked at over, 100 years, 50 years or 100 years. So it's a pretty long time. and look at just how extreme this cycle has been. 30-year rates, I wasn't lying to you guys. There's your 1980 at 18%. 18% mortgage rates back in, 81, 82. You guys can see the trend has been down, and you can see, look at the COVID era, down even further, right? Down, bottom of the barrel. And now, all that cash and easy money and everything else has created some inflation, which has meant the Fed has to hike rates to combat that inflation. 30-year mortgage rate is at a 20-year high, highest level since 2000. Actually, excuse me, it's a 23-year high, isn't it? 23-year high. I believe it's the highest since, well, I can definitely tell you it's the highest since here. Excuse me, it's the highest since here. So it looks like 01. So I think that's a 22-year high. But I can get that exact figure for you. It's about a two decade plus high. Well, so what's going on, guys? Why all the heartburn? Why? Oh, that's why, right? The $600,000 house at 3% interest, right, is going to be a $2,000 a month payment. That same house, you might get a better deal on it. You might get 10 grand off, $590. But at 7% rates, you are going to be finding that the payment is $1,100 more per month. So that's obviously quite concerning. Looking at payments, you know what? Let's skip to the annual one. Looking at payments, 3 years ago, payment on a median home was $1,600. Now $2,600. That's $1,000 a month, or about $12,000 a year. That is a big change, guys. That's a big change. Let's see. Let's do a very quick look forward, right? So we get asked this from time to time. Are housing prices going to crash if we go into recession? The answer, as it is all too often, is maybe. But take some comfort in the fact that 4 of the last 6 recessions actually had rising prices from the beginning to the end of when the recession was sort of declared. 08 is a wonky one. You guys have heard me say that was a housing caused or a housing caused recession, mortgage housing caused recession. But other times, actually, home prices continue to rise. What does that mean? An economic recession does not necessarily equal a housing crisis. Okay, a very brief look forward, annual forecast. This is from NAR. So what they're saying for this year, they're expecting unit sales to be down about 7%, home prices to be pretty flat at 0%. But look at next year into 24, they're thinking 10% growth on unit sales and then 5% price growth on prices, 5% growth on prices. So that's kind of their estimate. This is from the Home Price Expectations Survey, and this is forecast as of the 3rd quarter of this year, so a couple months old. They're thinking this year will be about up 3 1/3. Next year, interestingly, they're thinking slower growth. I do not think that'll be the case here, but I guess we'll have to see. And then moving forward, they are seeing some acceleration in price growth. Not much, though, guys. Really not much. As we like to say, most agents know what's happening. Interest rates are up and sales are down. Good agents understand what's happening. The impact of higher rates decreases borrowing power or buying power because payments are really what matter, right? But great agents can explain what's happening to their clients. And I really think that's a good way to think through this as you guys approach our webinars, our reports, and the such, and to really think through, not just know what's happening, but understanding it and being so confident with it that you can explain it. And with that, I will say, you've invested an hour of your time with us. I hope I've given you a good return on that investment. It is our honor to do it. We love data. We love charts. We love talking about the market. And it is such a fascinating time, if not a touch discouraging in some ways. But it is an absolutely fascinating time to be tracking this stuff and looking at it. And it looks like we're seeing some light at the end of the tunnel. But yes, we are still in a challenging time. And speaking of time, we're right at 3 o'clock. So we're right there, guys. Let me do a quick check on chat. Michelle, it is our honor. I don't see many questions. All right. Was I that thorough, or are you guys just shy? Or off to a listing appointment, maybe?
Well, thank you, David, for not only a very data-rich hour of this monthly housing market webinar, but keeping it light and entertaining for all of us. If you are still sticking around with us for the final minute or so, I am going to put into the Zoom chat the link for our next, let's find it right here. The link for our next post, our next webinar is going to be right there in the chat for you. That is November 16th from 2 to 3, always virtual. And we will see you all next time. Thank you so much for being here.
Thanks, everybody.